Imagine waking up to find that your entire retirement savings, accumulated over decades of work, is suddenly worthless. This nightmare became reality for thousands of Enron employees on a cold December morning in 2001. In just a few weeks, one of America's most celebrated companies crumbled into ashes, dragging along billions of dollars in investor money and destroying countless lives. This is the story of how ambition, greed, and deception created one of the most spectacular business collapses in history. The rise to glory in 1985, Kenneth Lay founded Enron by merging two natural gas companies into what would become a titan of the energy industry. During the 1990s, when Congress deregulated natural gas markets, Enron saw an opportunity. The company transformed from a pipeline operator into a trader of energy contracts, positioning itself as the middleman between producers and buyers. This wasn't just smart business. It was revolutionary. A young consultant named Jeffrey Skilling joined the company and completely reimagined how Enron operated. Skilling brought the mentality of a trading floor to the entire organization. He hired the brightest MBA graduates from top universities and created an intensely competitive culture where employees were obsessed with closing deals and generating profits. The faster you made money for the company, the higher you climbed. Skilling eventually became the chief operating officer, and his philosophy became the company's DNA. Another brilliant mind who rose through the ranks was Andrew Fastow, a financial wizard who became chief financial officer. Fastow's job was to find creative ways to finance the company's increasingly complex operations. Together, Lay, Skilling, and Fastow built a powerhouse. By the late 1990s, Enron had become the seventh largest company in America with assets exceeding $60 billion. The company was consistently ranked as America's most innovative business by Fortune magazine year after year. Wall Street loved them, employees were proud to work there, and investors couldn't get enough of Enron stock. The hidden machinery, but beneath this gleaming exterior, something rotten was building. The problem started with a complex accounting method called mark-to-market accounting. Here's how it worked. Enron could estimate how much profit it expected to make from a future deal and record that estimate as actual earnings right away, even if the deal hadn't closed yet. If the deal later fell apart or made far less money than predicted, the company simply didn't address the losses properly. Fastow created something even more sophisticated to hide Enron's failures. He established special-purpose entities, basically fake companies that existed only on paper. These entities purchased Enron's failing projects and bad investments, getting them off Enron's official balance sheet. Money would flow in circular patterns between these hidden entities and the main company, making it nearly impossible for outsiders to understand what was really happening. The executives knew the truth. Enron was sitting on massive losses from failed ventures. The company had invested billions in projects that simply didn't work. Rather than admit these failures and write them off, they hid them. This wasn't just creative accounting. It was deception on an industrial scale. What made this scheme so insidious was that some of the brightest minds in finance, including the auditing firm Arthur Andersen, either didn't catch it or looked the other way. When internal accountants or board members asked questions about these mysterious transactions, executives either gave vague answers or intimidated the questioners into silence. The culture of corruption, the toxic culture Skilling created, made fraud easier. In Enron's hyper-competitive environment, employees learned that results were everything and integrity was optional. If you questioned the numbers or the tactics, you were seen as not understanding the sophisticated business. The company discouraged doubt and curiosity. Whistleblowers who tried to raise concerns were dismissed or transferred. This culture affected decision-making at every level. Traders were incentivized to make deals at any cost. Finance teams were rewarded for creative accounting. Executives were wealthy beyond measure because they held millions of dollars in Enron stock, so they had every incentive to keep the stock price rising, regardless of the company's true financial condition. The beginning of the end. By late 2000, the dot-com bubble had burst, and energy markets were softening. Enron's stock peaked at $90 per share and then began sliding. Analysts started asking harder questions about the company's finances. In October 2001, Enron reported its first quarterly loss, a shock to investors who had been told the company was invincible. 2 months earlier, in August, emails had surfaced from a mid-level executive named Sharon Watkins, who had warned management that Enron's accounting practices would eventually be exposed. She was ignored. In October, the Securities and Exchange Commission announced it was investigating the company's financial practices. That's when the house of cards began to collapse. The unraveling in November 2001, Enron announced that it had overstated profits by nearly $600 million. The company had also failed to disclose related party transactions that created massive conflicts of interest. Investors who had trusted the company panicked. Stock that had been worth $90 per share was now worth less than $1. Attempts to find a buyer or secure emergency funding failed. On December 2, 2001, Enron filed for bankruptcy, the largest in American history at that time. The next day, thousands of employees were told to pack their belongings. They had 30 minutes to leave the building. Nearly 62% of Enron's 15,000 employees had their retirement savings invested in company stock. Billions of dollars of shareholder wealth evaporated in days. The aftermath and Justice Kenneth Lay, the founder, claimed he was misled by those around him, particularly Andrew Fastow. He pleaded not guilty to fraud charges, but was convicted on 6 counts of securities and wire fraud. He died in 2006 before sentencing. Andrew Fastow went to prison. Dozens of executives faced criminal charges. Arthur Andersen, one of the world's oldest and most respected accounting firms, dissolved because it lost all credibility after the scandal. The Enron collapse shook Americans' faith in the stock market. It exposed a crucial vulnerability. The financial reporting system couldn't be trusted. Congress responded by passing the Sarbanes-Oxley Act in 2002, which imposed strict new regulations on corporate accounting and held executives personally accountable for financial statements. The lasting legacy more than 2 decades later, Enron remains a cautionary tale about what happens when a company prioritizes deception over integrity. The collapse demonstrated that even the most admired companies can hide catastrophic problems. It showed that competitive pressure without ethical guidelines creates corruption. It proved that when boards of directors, auditors, and the media fail to ask tough questions, disaster follows. The story of Enron taught investors, regulators, and business leaders that there is no substitute for transparency and honesty. In the end, Enron's fall was so complete because the truth eventually always comes to light.